There is an old saying on Wall Street, a proverb that has survived every crash, every bubble, every panic, and every recession since the days when men read ticker tape in smoke-filled rooms. It is a simple sentence, but if you truly understand it, it contains the entirety of market wisdom within its few words. The saying is this: there are old traders and there are bold traders, but there are very few old, bold traders. We live in a culture that worships the bold. From the time we are children, we are taught that fortune favors the brave. We are told to swing hard, to bet big, and to go all in. In business, in sports, and in life, we are conditioned to believe that bigger risks equal bigger rewards. It is the classic hero's journey. It is the cinematic moment where the protagonist pushes all their chips into the center of the table, calls the bluff, and walks away with the kingdom. We love that story. We crave that story. But here is the brutal truth that nobody tells you when you open your first brokerage account and deposit your hard-earned savings. In trading, that belief, the belief that you must risk big to win big, destroys more accounts, ruins more marriages, and shatters more dreams than bad analysis, terrible timing, and market manipulation combined. If you treat the market like a casino, the market will eventually treat you like a gambler, and the house always wins. The market is not a place for heroes. It is a place for survivors. Let's start by looking at the trap that catches almost everyone. It usually happens within the first year, often within the first 3 months of a trader's journey. You hear the golden rule of risk management, which states you should only risk 1 or 2% of your account per trade. You probably did the math in your head the first time you heard that. You looked at your account balance, maybe it was $5,000, maybe $10,000, and you calculated 1%. You realized that meant risking $50 or $100. And you thought to yourself that this was ridiculous. You thought, I am here to make a living, I am here to buy freedom, I am not here to make pocket change. You convinced yourself that playing it safe was for people who didn't have conviction, or for people who were scared. This thought process is the seed of destruction. Let's walk through what actually happens when you decide to be the bold trader. Let's say you have high conviction on a trade. You've done your technical analysis, you've checked the economic calendar, and everything looks perfect. So you decide to risk 10% of your account on this single trade. In your mind, you are calculating the upside. You are thinking that if this hits a 2-to-1 reward, you will make 20% on your account in a single afternoon. If you do that 5 times, you have doubled your money. It seems logical. It seems efficient. It seems like the fast track to the life you want. But markets do not move in straight lines, and probabilities do not distribute themselves evenly. You can have a strategy with a 60% win rate and still lose 5 times in a row. That is statistically normal. It happens to the best hedge fund managers in the world. So let's look at the math of the aggressive trader who hits a standard losing streak. You risk 10% and you lose. Your $10,000 is now $9,000. You are annoyed, but you are still confident. You take the next trade, risking 10% again. You lose again. Now you are down to $8,100. 3 more losses occur, just a typical bad week, a bit of market chop, maybe a news event that went against you. Suddenly, you are staring at a balance of roughly $5,900. You have lost almost half your account in a single week. This is where the mathematics of ruin meets the fragility of human psychology. The financial damage is bad, but the psychological damage is fatal. At this moment, your brain chemistry changes. You are no longer thinking about finding high-quality setups. You are no longer looking for an edge. You have entered survival mode. You are sitting there, staring at a screen that has eaten half of your net worth, and your only thought is that you need to get back to where you started. You need to fix it. This is where the trap snaps shut. Because you are down nearly 50%, you feel like you cannot lower your risk now. If you drop down to risking 1% to be safe, it will take you years to make back that loss. The math looks impossible. So, your brain convinces you that the only way out is through. You convince yourself that you have to keep risking big, or maybe even risk bigger, to claw your way back to break even. You are now trading purely on hope and fear, and the market mercilessly punishes both. Now compare that nightmare scenario to the boring trader. The one you thought was a coward. The one risking 1%. They take the same 5 losses in a row. They traded the same bad market you did. They are down 5%. Their $10,000 is now $9,500. Are they happy? No. Are they frustrated? Sure. But are they broken? Absolutely not. They are still playing offense. They are still looking for the next good setup with a clear head. They don't need a miracle to recover. They just need a decent week. One trader is trying to survive a catastrophe, while the other is simply managing a business expense. That is the entire difference right there. We need to talk about the math of recovery because this is the part that human intuition fails to grasp. Human beings are linear thinkers. We instinctively think that if we lose 50%, we need to make 50% to get back to even. But the math of percentages is geometric, not linear, and it is incredibly cruel to those who dig deep holes. If you lose 10% of your account, you need an 11% gain to get back to even. That is manageable. That is a good trade or two. If you lose 20% of your account, you need a 25% gain to recover. It is getting harder, but it is still doable. But if you lose 50% of your account, you need a 100% gain to recover. You have to double your remaining money just to get back to zero. Do you know how hard it is to double an account? It is incredibly difficult to do it properly. And now you have to do it with half the capital and zero confidence. If you are a true cowboy and you blow 75% of your account, leaving you with $2,500 of your original $10,000, you need a 300% return to break even. If you lose 90%, you need a 900% return. This is why the number one job of a trader is not to make money. The number one job is to protect the capital you have. Because once you dig a hole past 20%, the mathematical gravity begins to crush you. The safe trader who is down 5% only needs a 5.2% gain to recover. They are walking on flat ground. The aggressive trader is trying to climb a vertical cliff face without a rope. To understand the human tragedy of this, we have to look at history. We have to look at the life of Jesse Livermore. If you don't know his story, Jesse Livermore was arguably the greatest trader who ever lived. He didn't have computers. He didn't have indicators or algorithms. He read the tape. He understood price action and human psychology better than anyone. In 1929, when the entire world was buying stocks and the shoe shine boys were giving stock tips, Livermore saw the weakness. He went short. When the market crashed in October of 1929, families were ruined. Banks collapsed. People were losing everything. But Jesse Livermore went home to his wife, who thought they were destitute, and told her that they were not poor, but that they had more money than they had ever had. He made approximately $100 million in a few days. In today's money, adjusted for inflation and the size of the economy, that is the equivalent of making $1.5 billion in a single week. He was the king. He was untouchable. He was the man who beat the market. Yet, 5 years later, Jesse Livermore declared bankruptcy. You have to ask yourself how that is even physically possible. How do you lose $1 billion fortune in 5 years? He didn't lose it all on cars and houses, though he had those. He lost it in the market. Livermore fell into the trap that catches every bold trader eventually. He confused a winning streak with invincibility. He confused luck with skill. He started sizing up. He started breaking his own rules. He started thinking that because he had the massive bankroll, he could force the market to do his bidding. He averaged down into losing positions. He took massive risks because he felt he could always make it back. The market humbled him, and then it broke him. He lost everything, not once, but multiple times. But the final time, he couldn't make it back. The psychological capital was gone. In 1940, in the cloakroom of a hotel in New York, Jesse Livermore sat down and wrote a note to his wife. It read, "My life has been a failure." Then he took his own life. Think about the weight of that. The man who once controlled enough capital to corner the cotton market, the man who made more money in a single trade than most dynasties make in a century, died broke and broken. Why? Because he could not stop betting too big. He had the best analysis in the world. He had the best instincts in the world. But he lacked the one thing that ensures survival, which is the ability to sit on his hands and risk small. His story is the ultimate warning. If the market can destroy Jesse Livermore for trading too big, do you really think it won't destroy you? So why do we do it? Why do smart people, Doctors, engineers, business owners, people who are disciplined in every other area of their lives, come into the market and blow their accounts like reckless gamblers. It is not because they are stupid. It is because they are human. And human biology is not wired for trading. When you put on a trade with massive size, you are hacking your own dopamine system. You risk big and you win. Your brain floods with dopamine. It feels incredible. It is a chemical high. You feel like a genius. You feel like you have unlocked the code to the universe. You look at your screen and you see a month's worth of salary made in 10 minutes. That feeling is addictive. You want it again. But you don't just want it again. You develop a tolerance. A small win doesn't excite you anymore. You need a bigger win to get the same rush. So you size up. Then, inevitably, you lose. And now we have to look at loss aversion. Psychologists have proven that the psychological pain of losing is about twice as powerful as the pleasure of winning. Losing $1,000 hurts twice as much as gaining $1,000 feels good. So now you are in a hole. You are in pain. Your brain is screaming. The amygdala, the fear center of the brain, hijacks your prefrontal cortex, which is the logic center. You literally cannot think straight. Your IQ drops. You enter a state of fight or flight. In the wild, fight or flight saves your life. If a predator is chasing you, you don't analyze the wind speed, you run. But in trading, fight or flight kills you. Your brain screams at you to fight back, to get that money back, to make the pain stop. This is the physiological trigger for revenge trading. You are not placing a trade based on market structure anymore. You are placing a trade to medicate your pain. You size up to make it back in one swing. And because you are trading emotionally, you miss the details. You enter too early. You ignore the resistance level. And you lose again. Now the shame sets in. You don't want to tell your spouse. You don't want to look at your journal. You just want to fix it before anyone notices. This is the death spiral. It is a chemical feedback loop that keeps you pushing the button until the money is gone. Safe trading, risking that boring 1%, bypasses this entire nightmare. When you risk 1%, you don't trigger the fight or flight response. Your amygdala stays quiet. You can look at a loss and simply say that it was interesting, that the market didn't hold the level, and move on. You remain an observer, not a victim. You stay rational. And in trading, the person who stays rational the longest wins the money. Let's move from theory to reality. Consider two traders who start around the same time with the same starting capital. Let's call them Mark and David. On paper, they are identical. They watch the same educational content and understand the same strategies. Mark is the aggressive one. He hates his job and wants out immediately. He does the math and realizes that making small returns won't quit his job fast enough. He needs to make thousands a week, not hundreds. So, he decides to risk 5 to 8% per trade. In the first 2 months, Mark might catch a winning streak. He has a high win rate, and because he is sizing huge, his account flies. He doubles his money in 8 weeks. He is posting screenshots. He is feeling on top of the world. He tells everyone that trading is easy if you just have the guts. He feels like he has solved the puzzle. David is different. David likes systems. He decides he will never risk more than 1.5% of his account, no matter how good the setup looks. Mark makes fun of him. Mark calls it scared money. David just shrugs. In those first 2 months, while Mark is up huge, David is up a small amount. It is slow. It is boring. It isn't life-changing. Then comes the 3rd month. The market regime changes. It goes from a clean trend to a choppy, volatile mess. Mark keeps trading his aggressive style. He takes a loss. Down 8%. He takes another loss. Down another 8%. He feels that rush of panic. He thinks he just needs one big win to get back to his high watermark. He sizes up to 10%. He catches a bad slippage event on a news release. Another massive hit. In 3 weeks, Mark doesn't just give back his profits. He eats into his principal. He is now down money overall. The psychological toll is visible. He looks terrible. He isn't sleeping. He is snapping at his family. He is constantly checking his phone at work, hiding in the bathroom to trade. David, in that same choppy month, takes losses too. He has a drawdown. He loses about 4% of his account. He doesn't like it, but he sleeps fine. He looks at his data, realizes the market is choppy, and decides to reduce his risk even further until the market clarifies. Fast forward 1 year. Mark has blown up the account. He refunded it with savings, blew that too, and then quit. He tells everyone that the market is rigged, that it's all algorithms hunting stops, and that nobody actually makes money trading. He is back at his job, bitter and broke. David is still trading. His account has grown. It isn't a fortune yet, but he has compounded his skills. He has survived 4 different market cycles. He knows he can handle losses. He is slowly increasing his position size as his account grows. 5 years later, David is managing a significant amount of capital. He eventually did quit his job, not in a blaze of glory, but in a calculated, safe transition. Same strategy. Same market. Same starting capital. Different position sizing. Completely different lives. One treated it like a business. The other treated it like a lottery ticket. There is another factor that aggressive traders ignore, and it is the thing that usually kills them in the end. It is the black swan event. Aggressive traders assume that market liquidity is always there. They assume that if they risk 10% and put a stop loss at 10%, they will only lose 10%. But markets are fragile. In events like the pandemic crash of 2020 or sudden currency depegging events, the market can move 10 or 20% in a single day. Circuit breakers trigger. Prices vanish. If you are long with a stop loss, the market might gap right over your stop. I have seen traders who were risking 10% per trade get wiped out in a single morning. Not because they were wrong about the direction in the long term, but because the market gapped past their stop loss. They didn't lose 10%, they lost 30 or 40% on a single trade because of slippage and volatility. If you are highly leveraged, you can even go into a negative balance and owe the broker money. The trader risking 1%? Even in a black swan event, if the market gaps against them and they lose 3 times their intended risk, they lose 3%. It hurts, but it is a flesh wound. They survive. Volatility doesn't care how confident you are. It doesn't care about your technical analysis or your trend lines. It eats leverage. If you are over-leveraged, you are walking through a minefield hoping you don't step on the trigger. Eventually, you will step on it. It is a statistical certainty. Retail traders often have a completely distorted view of how professional traders operate. They watch movies about Wall Street and think professional trading is about making massive, high-conviction bets that risk the entire firm. The reality of a professional trading floor is boring. It is entirely focused on risk management. The best hedge funds and proprietary trading firms in the world, the people who generate consistent returns for decades, risk tiny fractions of their capital per trade. Rarely do they go above 1 or 2%. These are people with teams of mathematicians, satellites tracking supply chains, and fiber optic cables that give them data milliseconds faster than you. They have information edges you can only dream of. And yet, they play it safer than the average retail trader betting their rent money on an app. Why? Because they understand the law of large numbers. They know that their edge is small. A great trader might win 55% of the time. If you win 55% of the time, you are printing money, but only if you survive the inevitable losing streaks. Professionals focus on risk-adjusted returns. They don't care if you made 100% this year if you took risks that could have blown you up. Because if you took blow-up risk, it is only a matter of time before you blow up. Here is something that doesn't get talked about enough. It is honestly one of the most important concepts in wealth creation. When you take a massive loss, you are not just losing money. You are losing time. And time is the one resource you absolutely cannot buy back. Let's go back to the recovery math. Say you blow up your account. You lose 80%. You have to stop trading. You have to get a second job. You have to save up for 2 years to fund another account. Those are 2 years where you are not in the market. Those are 2 years where you are not compounding your capital. Those are 2 years where you are not refining your skills in live conditions. If you blow up your account and it takes you 2 years to get back to where you started, You didn't just lose 2 years of time. You lost 2 years of opportunity cost. Think about the massive opportunities that have happened in the last decade. The massive bull runs, the recoveries, the tech booms. These were life-changing wealth transfer events. But you only participated in them if you had capital and were in the game. I know traders who blew up right before major market rallies. They were sitting on the sidelines with no money when the greatest buying opportunities occurred. They watched stocks triple and quadruple, and they couldn't buy a single share because they had blown their account on some random Tuesday 3 months prior trying to get rich quick. Aggressive trading steals your time. It forces you to constantly hit the reset button. Wealth is built by staying in the game for decades, allowing the compounding to do the heavy lifting. You cannot compound zero. I hear the counter-argument often. People ask about the big win. They say, if I risk 10% and catch a 10-to-1 trade, I double my account in one trade. This is the siren song. It is seductive. Risk 1% and catch a 10-to-1 trade, you make 10%. Nice. Risk 10% and catch a 10-to-1 trade, you make 100%. You are rich. Here is the reality. You will never make it to that trade. To catch a massive winning trade that just keeps going, you usually have to endure a lot of small losses first. You have to probe the market. You get stopped out, you re-enter. You get stopped out, you re-enter. If you are risking 10% per trade, the false starts will destroy your account before you ever catch the big move. By the time the rocket ship takes off, you have run out of fuel. The safe trader survives the chop. They take the small cuts. They are still standing when the trend finally breaks out. They catch the move. Sure, they only make 10 or 15% on that move, not 100%. But they get to keep it. The aggressive trader is mathematically eliminated from the game before the winning card is dealt. So, how do we fix this? If you are listening to this and realizing that you have been the aggressive trader, the gambler, how do you change? Because it is not just about changing a setting in your software. It is about changing your personality. The first step is a detox. If you have been trading aggressively, you are addicted to dopamine. You need to stop trading for a couple of weeks. Let your brain chemistry reset. You need to break the cycle of need. You have to accept that getting rich quick is a lie. You have to grieve that fantasy. Let it die. Accept that trading is a get-rich-slow scheme. It is a profession, like engineering or medicine. It takes years. You must set a hard rule with your broker or in your trading plan. Maximum risk per trade is 1%. If your account is small, maybe 2%. But never, ever more. If you lose 1% today, you are fine. You also need to change your metrics. Stop measuring success by how much money you made today. Start measuring success by how well you followed your rules. Did you stick to your risk limit? If yes, that was a successful day, even if you lost money. You need to rewire your brain to value discipline over profit. Good trading should be boring. It should be like watching paint dry. If you are sweating, if your heart is racing, if you are shouting at the screen, you are doing it wrong. You are too big. Size down until you feel nothing. That is the zone where professionals operate. The zone of indifference. Let's go back to where we started. There are old traders and bold traders, but there are very few old, bold traders. The market is a graveyard of bold men and women. It is paved with the bones of people who thought they were special, who thought the math didn't apply to them, who thought they could outrun the probabilities. But look at the survivors. Look at the legends who have been pulling money out of the market for 20, 30, or 40 years. They all share one trait. They respect the risk. They are paranoid about the preservation of capital. They know that if they just stay in the game, the opportunities will come. The game rewards those who show up consistently, not those who show up occasionally with bags of money and a dream. You have a choice to make today. Do you want to be the person who tells stories about how much money you used to have? The person who almost made it? Or do you want to be the trader who is still here in 10 years, quietly compounding, building generational wealth, free from the stress and the panic? It's not exciting. It's not going to go viral. But it works. Stop trying to conquer the market. You can't. The market is bigger than you. It is stronger than you. Stop trying to be bold. Be old. Be the old trader. Be the one who survives. Because in the end, survival is the only skill that matters.